Welcome to the American Society of Quality Lean Enterprise Division 2015 webinar series. By listening to our webinar series, you will get the best of the best in the lean industry. Stay tuned to the end of this recording for more details. This month, our speaker is Brian Maskell. Brian's consulting firm BMA Incorporated is focused on lean management and lean accounting. BMA works with large multinational companies worldwide, but the majority of their time is spent with small and medium-sized companies striving to become truly lean organizations. Now let's join Brian as he presents Making Much More Money with Lean.
And so we'll start off with the economics of lean. Now the beginning point of that, of course, are the principles of lean. The first principle of lean is everything starts from the value to the customer, isn't it? We have to have a deep and well-established knowledge of what it is that creates value for the customer so that we can make more of that value. When you make more of that value, you grow the business. We always work by value streams. We make, manage, measure, and improve by the whole value stream, not by a whole lot of departments that are separated, but value streams that are horizontal flow, which starts with sales to the customer, goes through purchasing material, making the product, shipping the product, and so on. The third is it's all about flow. It's all about flow and pull. We want, with lean, what our focus is, once we've understood value to the customer, we then work out and say, what do we have to do to flow that value much more quickly? Now, lots of people know about the 7 wastes or the 8 wastes as it's become now. I think there might be a 9th one coming along soon. But yeah, why do we want to eliminate waste? Well, it's so that we can make the thing flow. So if it used to take you four weeks to make something and you can now make it in 3 days, that's going to make you flow much more quickly, and that's what we're focused on in lean. The fourth is empowered people. You know, lean is not done by experts. It's not done by top-down management. It's done by engaging the entire workforce in improvement projects at every level. Some are huge breakthroughs, yes, but most of them are small, weekly, monthly improvements that add together into enormous benefit. And then the fifth, of course, is pursuing perfection. You know, how long is it going to take you to get to your company to become perfect? Well, it's going to take more than your lifetime, probably. And so what does that mean? It means that lean is not a project, but lean is a different way to run the business, and we've got to work on it year after year after year. And then the opposite of that, if you want to think of it that way, means that we don't have to do everything at once. You know, we want to do hundreds of small projects that all add up together to making lean. And we do lots of small things rather than huge breakthrough stuff. So those are the 5 principles of lean. And this relates directly to the economics of lean, because contrary to what the survey said, that lean's not about cost cutting, it's about growth. And the focus of lean has to be the growth of the business. We have to understand customer value. That's the starting point of lean. Then we eliminate waste, and when we eliminate waste, we free up capacity. Now, when you eliminate waste, do you cut cost? Well, yeah, you cut some cost, don't you? You know, if you've maybe you've improved the quality of the process, and maybe some material costs have gone down. But by and large, there's not a lot that actually reduces cost. Now, of course, a traditional company would say, well, we'll make an improvement, we'll take away work, and then we'll lay people off. But of course, if you fire people as a result of lean, and the improvements need to be done by the people who work in the company, then the people who work in the company are pretty soon going to work out that they really don't want to do this lean because it results in layoffs. So in lean, we are really focusing on eliminating waste and freeing up capacity. And then the question is, what are we going to do with that capacity that we've freed up? Well, what we have to, oops, press the wrong button. What we have to do then is design, make, and sell more products, which then creates more value for the customer. And we've got a circle going around there that's really building up to massive growth and massive cash flow. So that's the economics of lean. That's how lean works. Let's look at this in a bit more tangible numbers here. We've got a value stream. We sell 1,000 units. Price is $200. What's the revenue? $200,000 a month or whatever. Material cost, 120. Production cost, or really the whole value stream cost, is $60,000, which means we're making $20,000, which is 10% of our revenues. Now, we do some lean improvement. We free up 20% more capacity. What happens now? Well, we're going to sell 200 more. What's the cost of those extra 200 units? Well, the answer, of course, is nothing, isn't it? Just the material cost. And so what does our income statement look like now? Well, the revenue's gone up by 20%. Material costs gone up by 20%, although we may get certain reductions as a result of volume or something like that. And then the rest of the value stream costs stay the same. So our profit now goes from $20,000 previously up to $36,000, which is much better. However, the real issue is this. Yeah, our revenues increased by 20%, but we've created 80% more cash flow increase. And that's why you find companies that are serious about lean are developing huge amounts of cash, because that's what happens when you use lean to grow the business. It creates a huge amount of cash. And then, of course, you can use that cash to design new products, to acquire other companies, for example, and growing the business in a very radical way. And there's hundreds of examples of this, and of course Toyota started off as the first big example. Did you notice in the recession time of 2008, 2009, all the car companies were closing down factories, but Toyota didn't do that? One of the reasons was because they had loads of cash. Now, of course, they stopped making a lot of cars because there wasn't demand, but nobody was laid off and nothing was closed down. So much more money from lean. It's the economics of lean. It's not about cost cutting. It's about growth. Now, when you're deciding what's the best lean improvement, who do you need to include in making those decisions? Well, you've got to include sales and marketing, haven't you? Probably you've also got to include new product development, because if operationally we're going to improve our processes and free up capacity of all kinds, not just production capacity, but capacity of all kinds, who's going to fill that capacity? We've got to sell more. We've got to have new products that meet new customers' needs. We've got to be able to have products that really focus on value to the customer. So when you're putting your value stream maps together, sales and marketing and product development are very key players in that process. And their job, of course, is to harness that newly created capacity so that we can get maximum financial benefit for the company. So that's the economics of lean. Now we're going to now look at, these are the four areas we're going to look at. We're going to look at the true financial benefits of lean, 5 ways of making more money with lean, and then how do we make decisions. But before we jump into that, Paul's got another poll question. So Paul, go ahead. Paul, go ahead.
It's actually already up, Brian, so you can go ahead and continue to talk, and I'll close it here in a second.
Okay, in which case we won't have a poll question. I'm going to move ahead. So let's look at the true financial benefits of lean change. So what is the true bottom line increase in cash and profits? So here we've got a current state map and a future state map. We know what we're going to change, and we understand what those changes are going to be. How are we going to work out the financial benefit of that and the operational benefit? Well, we use this thing called a box score. I don't know if any of you have seen this.
Brian, let me interrupt you for a second, Brian. We do have the results of the poll. The results were 26% said yes, 48% said sometimes, 26% said no, and 1% said they didn't even know they had an accounting department. So there you go.
Okay, what percentage said yes, Paul?
The percentage that said yes was 26%.
Okay, so it's about a third, isn't it, here? Yeah, okay. Good. All right, I'll come back to this then. So if we want to understand the financial benefits of lean, we use this box score. And this shows right now the current performance of the value stream. So you can see that, press the wrong button, here we are, operational performance measurements. That's the piece that's at the top of the box score. And there we've got what in this case 6 operational measurements that tell us the performance of the value stream. Now, of course, every value stream has different kinds of measurements, but all of them need to be measurements that are focused on lean.
Brian?
The second part down the bottom here is the... Yes.
Brian, can I interrupt you for just a second? Someone asked that if you could go back to slide 13 for just a second, please. They would like to see that. I think they missed that because the poll was up.
Oh, I see. Okay. I apologize. I got the timing wrong. Okay, so making more money with lean. We're now going to look at how do you calculate the true financial benefits of lean change. So we've got current state maps and future state maps. I'm sure many of you have worked on those or worked with those. And the current state shows how the value stream is now, and the future state is our plan for the future, let's say over the next 3 months or 6 months or whatever the time frame is. And now what we want to do is to say, here's the current state, and what will the future state look like operationally and financially? So we have operational measurements, and then we have the financial results for the value stream. That's a kind of summarized income statement with revenue and costs and profit, and then how that matches against the expectation. If you look at the bottom left-hand side, for the company to be successful, this value stream has to make a 28% return on revenues. Right now it's only making 17, if you look at the bottom of the column there. So it's 11% off track. And then the third piece on a box score looks at the capacity. And so here, are we making good use of our capacity? How much of our time is spent doing things productively? In this case, 69%. Now this might be the people's time or the equipment time or the flow time or some combination of those, but it's the time that's being used. And then the non-productive time, how much time is spent doing things we have to do but are non-productive? 32 in this case. And then we've got available capacity of -1%. So these people are really running hard at the moment and very much overloaded. So that's the box score. And in this webinar, I'm going to show you several ways to use the box score to kind of understand the financial benefits of lean improvement. And if you want to think about it this way, a box score is kind of standardized work for the performance of a value stream. It's on one sheet of paper. It's the sheet of paper is large enough that anybody can read it, even if they're over 40 and wear glasses. But it's standard work for really understanding the performance of the value stream. Now, what's the true financial benefit of lean? Well, how much money are we saving? That's a good question, isn't it? You know, 68% of you said you're doing lean for cost cutting. Well, it's a good question to say how much money are we saving. A better question, though, would be what are we going to do with that freed up capacity? Because that's the way lean works, isn't it? You take away the waste and free up capacity. So that's, I think, a better question. And we need to be able to address that question. Now, here's our box score again. And what you can see here, we've got the current state here. And then this is the changes that we expect to make as a result of the 3 Kaizen events that we're going to do, let's say over the next 3 months, 1 a month, major improvements events. And then we sum those together, and this is the future state. So if you look here, the future state, the operational numbers are actually pretty good. You know, we're going to get better at shipping on time. Our inventory is going to go down, which means we're flowing much faster. Our first pass yield is going up better. Average cost coming down a bit. But when you look at the financials, there's not a lot to show for it. You know, we're going to go from 242,000 profit up to 267. Not a big deal, really. And so what's really happened? Well, you can see it in the centerpiece here, haven't you? What you've really done is freed up a whole load of capacity. We used to have, at the current state, or we currently have, we have -1%, everybody's running around overly busy. But now, as a result of these changes, we've freed up enough capacity that we now have 20% available capacity. So the real question now is, what are we going to do with that available capacity that's going to make us tons of money? Now in this example I've just put 3 outcomes here. When you do this for real, you generally come up with, I don't know, 12, 15, 20 different scenarios, and then you can select the ones that make more sense to you. So the first one there, we could say, well, let's take people out. And we can see the results of that, operationally and financially. The middle one is actually rather the one that this company this was built on actually did, which was introduce new products with which have got higher prices because they have a lot higher value to the customer. And that adds a great deal more revenue and a great deal more profitability. If you can't do that, maybe we can insource some products that are currently outsourced. But as I said, when you do this, you'd have a lot more on this list, but I think you can probably see this is the kind of things we'd want to be thinking about before we actually did our improvement events. Sometimes we work with companies where they've done this and they've said, gee, you know, we're not getting enough benefit for all the work we're doing on this, and they go back and work out different Kaizen events or different improvement approaches. So that's the basic way of looking at that. So we want to calculate the true financial benefit of lean. It's about the bottom line amount of cash that's going to go in the bank. See, any calculations that are based on a standard cost or based on an individual product or individual process is not going to give you valid information. We want to know in this value stream how much more cash is going to go in the bank, and that's the financial impact. So we want to maximize the financial impact of the improvements we're making, and we want to add more value and get the most profits and the most cash flow. Now these are real financial improvements, and they will show up on the company's income statement and balance sheet. Now, I don't know how many of you have come across this, but it's very common for people working in lean to, you know, work out some way to say, well, this is the financial improvement. You know, they might take the standard cost and they say, you know, we've taken 10 minutes out of the process, therefore the cost of the product has gone down by $100, and we make 10,000 of those a month, and multiply one against the other, and then you say that's what the saving is. But very often those things will not touch the bottom line. They won't go on the income statement, you won't find them on the balance sheet. And then you get conflict between lean people and the operations people and the financial people, and the whole thing becomes ridiculous. But so what we're looking to do here is to say how much more cash goes in the bank as a result of this, and doing it across the value stream as a whole, and that shows us the financial benefit. And of course at the same time we see what the operational benefit is as well. So we've looked at the economics of lean, and we're looking now at calculating the true financial benefits. I now want to move into 5 ways to make more money from lean. So let's take a look at this. Lean is very different than traditional companies. The way that you think and the way that you work is very different. And the traditional financial methods, using standard costs and variances and the normal things that you find in most companies, they actually don't work for lean. Now, it's not that they're bad or wrong. The traditional financial methods have served as well for a long time. But lean is very different. The underlying things we're trying to do with lean are very different from what traditional companies are trying to do, and that's why we need something that's a little different. Here are the 5 things we're going to look at. Timely information that everybody can immediately understand and use. Better financial information, better decisions, which leads to more revenue and more cash. The right measurements, the things that will motivate people to do continuous improvement. Maximizing the benefits of lean improvement and Kaizen, so we get the best bang for our buck on that work. And then also this what we call lean accounting is also just a lot less work for the financial people, but also for the operational people. So timely information that everybody can immediately understand and use. Now it depends on the company, but typically what we would want is to be tracking that on a weekly basis. So frequent reporting. The other thing we want is what we call plain English financial statements. You know, if you go to a company and you ask how many people understand the financial reports. And it's actually astonishing. It's very, very few people. Now, why is that? Is because the company employs people who are stupid? Of course not. It's because the financial statements are wrapped up in all kinds of complicated accounting gobbledygook, that it doesn't give information that could be used by someone on the shop floor, or someone who's working in sales, or someone who's working in product development, or someone who's in the administrative side of the business. So we want to have typically weekly reports, and it's got to be something that is immediately understandable to anybody in the company. Now that means then if we do it frequently, we can react to problems much more quickly. We can control the costs as well. You can't control something that you only see 12 times a year and is probably 2 weeks late after that. It's about 5 or 6 weeks late. But you can if you get the information quickly and in a usable format. We can go to immediate solutions. It's the other thing is, if you're going to a monthly thing, really you're trying to run the business on a rear view mirror. You can't drive forwards if you're looking in the rear view mirror. And what we want is to create something like I don't know, a GPS or something like that that's actually taking us forward and taking us in the right direction. So look, this would be a simple version of a traditional statement. We've got revenues at the top. That's good stuff. We sold $2 million in period 1. Cost of goods sold is the value of those items sold, but at standard cost. Then if you subtract the revenue by this cost of goods sold nonsense, then you get gross profit. But what does gross profit mean? I've asked this to, I don't know, thousands of people maybe, but the revenue minus what it would have cost us if we achieved standard, what does that mean? I don't think it means anything really. Underneath that then we've got all of these baffling variances. I've only put 4 in this example, but many companies have a lot more than that. And then of course we've got SG&A, which is some overheads. Now then you look at these two. We've got period 1, period 2. Period 1, the profit was 197,000. Period 2, it was only 99. Now why was that? If you looked at this, what's happened? Why is the profit gone down? Very few people would be able to understand that from looking at these numbers. Now I can't hear your answers to this, but just ask you, how many people in your company would look at this and be able to really understand it? Working with a company right now, and they sent me their financial reports, their monthly financial reports, just actually yesterday, and it's got 268 pages. Now, who's going to be able to go through that and really understand it and use it? So these are the problems that we're trying to overcome. So what would a lean income statement look like? We call this plain English. I borrowed that from Wiremold, that terminology many years ago. And you see the revenues are the same, but what have we got below there? We've just got the real costs. How much do we spend on materials? How much do we spend on the people that work in our value stream? What's the cost of the machines? What do we send outside? Now, facilities, we calculate that based on a square footage, so that's a sort of allocation. But all the rest of these costs are real actual costs in the value stream. So we've got revenues of 2 million at the top. Our total cost, if you look at the bottom of the costs there, come to 1.7, and so we've made a profit of 299,000. Now, when you get to the month end and you've got to do reporting to the government and the tax man and all that, then you're going to make some adjustments based on inventory changes, and also you're going to have allocations of costs from corporate and other places. But put all those together, and then you wind up with the same net profit that you showed on the traditional statement. Now, mostly we wouldn't look at those last few lines. They're more for the accountants. But the ones above that, we would be wanting pretty much everybody in the company to be able to look at this, understand it, and use it. And certainly value stream managers and people that work in the value streams. So that's what we're after, is simple information that comes on a very frequent basis. Now, the second thing we're looking for is better information for better decisions. Now, of course, that comes out of the same thing. We want to have real bottom line costs that say, if we make this, if we do this, this is how much cash will be in the bank. If we do that, this will be how much cash should go in the bank. So if we take this order from this, we would never look at what's the cost of the product and what's the margin. That would tell you nothing about whether this is the right thing to do. What we would want to see is, if we take this order, how will that affect the cost that goes into the bank? So we want better decisions. We want a whole lot of what-ifs so that we can look at it in a deep way, particularly if it's a substantial issue. And we want to see what is the financial impact on the value streams of the organization as a result of this. And we would set these up in very standard ways. So no confusing accounting methods like allocation and overheads and absorption and all that. No distorted information. Clear information that people can understand and then make decisions. Here's an example here. So we've got this company, they get a request for quote from a customer rather, and they're going to, they want to buy 3,000 ProValve 602s a month. I won't bother with telling you what this is, what a ProValve is, but this is a real company. Now their target price for that product is $45 a unit, and the company requires a minimum of 15% margin. Should they take the order? No, of course not. Price is 45, standard cost 42. The margin on this is less than 6%. So nope, they won't take the order. So the sales guy is about to call the customer back and tell them to get lost, when the purchasing guy says, not so fast, maybe we can source this in a low-cost country. And sure enough, they take a look at a Far East supplier, and they can get a landed cost of $33 for the same item. So should they take the order now? Well, yes, they should. The price is $45, the cost is $33. Now the company adds some additional overhead because of the, they recognize that going distant low-cost countries that there are additional costs, so they add another 7.5%. But we're still then making this so-called margin of 21%. So yep, they should take that order. So the purchasing guy is about to pick up the phone and order a boatload of these from this Far East supplier, and I mean actually a boatload. And we're not so fast, says the value stream manager. Maybe we can make this economic in-house using Lean. So the company doesn't have enough capacity, but if we make it in-house, we're going to hire 2 more people, buy a couple more machines. So what is this going to look like? Now I've laid this out a little bit differently into this current and future state. So here's the current state, same as we had before. Then when we take this new order, there's going to be changes. The revenue goes up, material goes up, labor and machine costs go up. Excuse me. Other conversion costs, just for sake of argument, we'll keep those the same. Now if we take the current state and then we add in those new numbers, we get the future state where the revenue's gone up and the costs have gone up, and sure enough, that's going to make plenty of money for us. So let's compare the 3. Well, on the left-hand side here, we've got the current state. If we made this decision with standard cost and a margin, nothing would change because we wouldn't take the order. If we buy it from a low-cost country, yeah, we're going to make a good deal more money, and it's going to improve our return up to 17.6. If we make it in-house, in this example, that's the right thing to do. Well, that would give us the most money, right? Now, of course, this analysis will just tell you what's the financial impact. There might well be all kinds of other business issues, but certainly from a financial point of view, making it in-house is the right way to go. So that's what I'm talking about, of making decisions not based on the individual product, but looking what is the impact of this on the value stream as a whole, and how much money is going to go in the bank as a result of this. So number 3 then, the right measurements. So we've been talking about financial stuff up to now, but measurements really make a huge difference. We've got to have good Lean measurements, we've got to have good Lean financial results, and we've got to have measurements that motivate Lean change and that enables everybody to see that, that Lean is going ahead. Now, traditional accounting would use things like efficiency. Sometimes it's called productivity. Should take 10 minutes to make. this guy did it in 11 minutes, and this guy did it in 8 minutes, and so we could measure one was more efficient than the other, and one was significantly under efficient. That's a really anti-lean measurement. If you this company I just mentioned that I got the big statement from, they measure that every day and report each individual person on their efficiency. Absorption, so this is absorbing overhead, if you're familiar with any of that. You know, if you get to the third week of the month and you're not making good enough money in a traditional accounting, you could just make a whole lot of product that the customer doesn't even need, and your profits will go up. So this traditional accounting actively undermines what we're trying to do strategically as a lean organization. Number 4, then, we want to maximize the benefits of lean improvement and Kaizen. So we've got to show how directly on the financial reports how that works. We want to focus attention on value and, of course, on growth. And again, traditional accounting can't really easily show you the financial impact of lean because it's all based on standards and variances and this kind of stuff. It's difficult to get that number. You can, of course, do it, but if you do that, you would do it outside of the system, and also the results would look bad because of the way that traditional accounting is set up. So we want to have something better, similar to what I showed you before. Now again, don't misunderstand me. I'm not railing against traditional accounting systems. They served us well for years, and they've been well thought out and used by thousands of companies. It's just that they don't apply if you're serious about being a lean organization, because the fundamental rules are different, and therefore you need to measure different things. Now the last one then is lean accounting is just a lot less work. You know, we report our financials at the value stream level. We don't have a lot of detailed financial reporting at the product and sell levels and those kinds of things. Why is that? Because we are controlling, the control is done operationally at those levels. And the operational measurements are what creates that control. Now that means then that we don't have to do all this detailed tracking through an ERP system. We don't need variance reports. We don't do allocations. We have these people-friendly visual management at the cells, at the value streams, at the design areas, at the shipping area, that we work using visual reporting, and that gives us much better control of the operation, which means that we can then use the financial information at a much less detailed way. And traditional accounting was designed for what, 1920s efficiency, mass production. It's not bad, but it's the opposite of lean, and that's what we're trying to get against. Now we've got a company I was with just recently. We've been working with them. Well, we've been working with the corporation for a long time, and this particular division we've been working with for some time. And the financial controller said that half of his work has gone away as a result of using these kinds of methods. And now he's spending his time on strategic purchasing, and he's also become a lean leader as well. So this is exactly what we're trying to do with lean, is to take away waste, in this case waste in the accounting system, and then free up people's time to do things that are going to prosper the company and grow the business. And that's exactly what this financial guy is doing. Now, so if we can free up people's time, then we can free up the time of the leaders. See, decision making can be made at a much lower level if we've got good information everybody understands and standard methods for making decisions. And that means the decisions are made closer to the work so that people have more up-to-date, detailed knowledge. It frees up the time of the leaders, like this controller that I just mentioned, and the leaders then are doing less of the sort of tactical day-to-day work and getting much more involved in strategic stuff and working with the customers, increasing the value. So that's another benefit that we're always focusing on when it comes to lean accounting. And what's more here, this isn't a one-time gain. You know, month after month, year after year, you eliminate waste, free up capacity, then you can design, make, and sell more products. That leads to more growth, which leads to more cash, which then leads to you introducing new products, going into new markets, acquiring synergistic companies putting new innovation or putting innovation into the operation. This is how lean accounting supports what we're trying to do as a lean organization. Now, can you see how this is very different from just saying, well, we want to do lean and then we're going to lay some people off and cut our costs? This is a much more focused approach to lean and much more successful, and certainly in line with what all of the really good lean companies do. Okay, before we get on to decision making as such, let's go on to the poll question number 3. You ready on that, Paul?
Just launch the poll question, Brian. It'll take about 30 seconds and we'll have the answers.
Wow, these guys are fast.
While we're answering the poll questions, just remember, if you have any questions, enter them in the question pane and we will answer a few at the end and others in a later broadcast that will get you good answers to all your questions. It looks like the results are, Brian, 11% make decisions daily, 55% summarize what happens, summarize what happened, 27% make project decisions, and 7% don't use accounting data really at all.
Okay. Okay, so I think if you look at the stuff that I've gone through, I know I've gone through it rather quickly, but really what we're trying to do is to put operational and financial information and decision making right at the place where the work is being done. So moving that down to, or moving it into the make decisions daily on the poll question there, and certainly making project decisions would be important. But again, we'd want to do it in terms of how does this project match to what's happening in the value streams. We wouldn't be looking at individual products or a small part of the business. We've got to look at the whole flow. And that's, of course, fundamental to lean, isn't it? It's the second principle of lean. First is customer value, but then second is we work in these value streams, and we have to look at the whole value stream impact, because that gives you what really happens and the cash that goes in the bank. Okay, so let's look at decision making here. All kinds of different decisions going on in your companies, aren't there? And what are the best tools and methods for lean when we're making those decisions? And you can see some of them here. We've got A3s at the top, on the top right there. We've got on the top left, we've got box scores that we use. In the middle, we've got detailed control going on at a cell level. That's a day by the hour board or something like that. We use maps like the current and future state maps to understand this. We have financial reporting. If you look at the left-hand side, this actually is a company level reporting of the operation. This is a medium-sized company. They've got about 12 factories worldwide. And the executive team, all of their reporting is done at a visually in this, what they call an Abaya room. So lots of different tools and methods that we can use. I want to give you just a quick example on this. You've got a value stream that currently earns a price of $22.53 per item. So their average price for the products that they make comes to $22.53. The average cost of a product is $17.92, which gives you an average profit of $44.61. Now, a large company in your industry, and this actually is a behemoth with a lot of power, that's approached you and they want to distribute your products in a market that you don't work in yet. And they want to pay $15 a unit. Now again, the same question is, should you take this business? They reckon they can sell 14,000 units per month, which represents about a 20% increase in the demand for your product. So this is a major decision. Should we take this? Well, what would most companies do if the cost of the products the average cost in this case, because it's a range of products that they're selling. But if the average cost was $15, sorry, the average price was $15 and the average cost was $17.92. And most people would say we're going to lose money on that, we shouldn't take it. So let's take a look at this. So here's our box score. And again, we don't make these decisions on individual products. What we do is you say, how will this impact the value stream as a whole? And so if we have an additional 14,000 units, you can see what's happening to the operational numbers. You can see what's happening to the financial numbers. It's also going to add additional productive and non-productive time. And what you can see there then is that if we take that order at the $15 level, then our profit's going to go up from 322,000 up to 286,000. So that's what, another $44,000. It's not stellar, but it's certainly an improvement. Now, first thing here is, all I'm doing here is showing the numbers. Now, of course, this is a business decision, and there would be a whole lot of different issues that might come into play here. But from a financial point of view, if we took that order, we'd be making a significant amount of more money. Now, how are we doing that? Well, we're working a little bit of overtime. We've got enough capacity, but we don't need to hire any more people. And of course, the revenues of materials go up as a result of that additional quantities. Now, the company then begins to think about this. Well, what if the price was $12 a unit? And so they go back and do their research, and they work out that if they put the price down to $12 a unit, then they'd be able to sell 28,000 a month, not 14,000. Okay, I've tidied up these numbers a bit, but it's a real example, but I've just simplified it. So let's take a look at that. What would that look like? Well, if the price goes to $12, it doesn't look good, does it? Our profits would go down from 322 down to 311, and that we'd be in bad shape. Why is that? We've got to hire 12 more people. We've got to get more planners. We've got to purchase a whole bunch more machines. We don't get any extra overtime. Material cost goes down a bit, but it's still, the price is so low, it's a bad business decision. Okay, but then the engineers are saying, you know, if it's going to be 28,000 units a month, that's 40% of our business. Why don't we create a value stream of its own to handle these products, and let's make that a highly automated value stream? Well, that would be another example, isn't it? We want additional volume, and now we can do that 28,000, but now this is in a highly automated approach. And you can see from these numbers that actually gives them a much better result. Now again, I'm not saying you just look at the bottom line and that's the end of the story. There's all kinds of other issues that you'd want to take account of. But this box score approach will show for each of those different scenarios, and a whole bunch more if you had them, that would show you the true impact, the operational impact, the impact on the capacity of the operation and how the people and machines are being used, and the financial outcomes. It would show you that, and that would be real bottom line numbers. And if you've got real bottom line numbers, then you can spend your time making the business decision, not sort of arguing about, well, what do these numbers mean and what does that mean and so on. So that's what we're after with this. We also use a box score because it's this standard work, it's standardized approach. So how do you make good lean decisions? Well, we want better decisions which lead to better revenues, profits, and cash. So all routine decisions are done using a box score. We need to see the impact of that decision on the whole value stream, not the individual product or process. And this then gives us real operational capacity and financial information. And we can do all kinds of what ifs and a whole lot of analysis, focusing our attention on the numbers and the standard approach gives us enables us to do this in a very valid way. So how do you make much more money from lean? Well, we've got to really understand the lean economics and drive our lean growth around those economics. We've got to be able to calculate what's the financial benefit of the lean improvements we're making, because lean's a lot of hard work. Excuse me. Lean's a lot of hard work, and we want to get the biggest benefit for the time available. And then we've got some specific ways of changing the way that we do our financial reporting so as to drive lean methods and lean thinking into the business. Now, the traditional accounting will force you to go the other way. The traditional accounting will give you results that say doing the lean things is a bad idea. And again, as I've said before, not because the traditional stuff is bad and wrong, it's designed for something that is very different from lean. And so we have to have different ways to approach that. And then we want to make good lean decisions, because better decisions lead to better results. Now, if we do this well, standardize the approach, use real numbers that people can understand, use a box score so that's standard and clear-cut, then we can have these decisions made much more quickly and made at the local level, which will lead to better results. And that will also then free up the time of the senior people to be doing things that are going to move lean forwards. So that's how you make much more money with lean. So thank you for your attention. And Paul, we're going to go to questions now?
We do have a couple of questions. The first question is, what is the hurdle rate?
Yeah, the hurdle rate is the percentage of profit that the value stream needs to make in order for the company as a whole, or the division as a whole, to be able to make the profit that needs to be made across the whole company.
There's actually, I'm sorry.
Go ahead.
There's actually an associated question with that. On slide 39, the 22% rate doesn't exceed the 28% hurdle rate. Should you take the business if it is less than your desired hurdle rate because it will consume capacity for possible other work?
Sure. Well, two things here. First is, these numbers are sort of made up, although it's based on a real thing. But first thing is, if we did this, we would be 2% closer to the hurdle rate than we are now. But you're dead right. So that's why these box scores, we wind up with many columns when you get into these things, because yes, we might be able to make money on this, but it might not be our best opportunity, is it? And so we would need to do we need to look at many different options and see which is the best option operationally and financially, and how does that affect our capacity. So none of this is look at the bottom line and say yes. This is all about having good information so that people can make valid decisions.
We also had a question back on slide 31. Why?
Wow, these people are really detailed, aren't they?
Why did the profit go down on sheet 31?
Mm-hmm. Traditional accounting shows that efficiency, absorption, and profit have gone down because when you do lean things, they are doing things that are, what we're doing is things that are the opposite of traditional accounting. So that means that when you then, if you work for 3 months doing lean things, the financial results will show that there are bad things are happening. They will show that the efficiency of the operation is less efficient, not the operation, but the individual people. The efficiency of the people will go down because those people will be working on other things than just making product. Also, we don't overproduce. So if you overproduce, you get efficiency. Lean companies don't overproduce, and therefore their profit would go down on the traditional income statement. Similarly with absorption, if you say, the customers have only ordered, pick a number, the customers have ordered 60% of what we expected, and we haven't made as much product as we expected to make this month. Well, if you're looking at overhead absorption, you would go and build a whole lot of stuff and overproduce. And that would then show good numbers on traditional accounting. But a lean company wouldn't do that. They would say, we're not going to overproduce. Little aside on that, it was focus on the overhead absorption that bankrupted General Motors in 2009. I won't go into that in any more detail, but there's been a couple of academic studies, and it's their adherence to traditional accounting that bankrupted them.
We also have another question about hurdle rate. Is hurdle rate similar to break even?
No. Hurdle rate is making tons of money. So let's suppose that the company as a whole needs to make 15% profitability. Well, the value stream in this case would need to make 28%, because they've got to make the 15%, but they've also got to cover the overheads within the company. There's the sales costs maybe, and the administrative costs, and maybe even some R&D costs. And so they've got to make so if they achieve 28%, then the company is achieving its budget. Now, of course, in lean accounting we don't do budgeting, but if you did, the company would be achieving the budget.
How can you translate resource consumption accounting of a project to capacity?
Yeah, I don't know the answer to that. I'm not a big fan of resource consumption accounting because it's extremely complicated and detailed, and in lean we want to make things that are easy for people to understand. So I haven't really, I don't really know the answer to that question.
Does lean accounting fit within GAAP rules?
Oh, of course, yes, GAAP. Yes.
GAAP.
Yeah, that's generally accepted accounting principles. Yes, lean accounting is 100% adherent to GAAP, and we have many customers who are doing regular GAAP reporting directly from lean accounting. You could even make an argument that lean accounting is better than traditional accounting for GAAP purposes, in that all of lean accounting is done with actual cost. And as you know, GAAP reporting has to be done at actual cost, whereas traditional accounting is often done at standard cost and then with a whole lot of adjustments at the month end. But that's a minor thing, but certainly the answer is yes.
Okay, at this time we have one last question.
Okay.
You mentioned a minute ago, in lean accounting we don't have budgeting. What do we do instead?
Okay, well this is a big story, but part of lean accounting is what's called sales operations and financial planning, and that's very similar to what most people do, or most people try to do anyway, S&OP, sales and operations planning. But we put a big emphasis on the financial outcomes of the planning, and so we do financial planning on a monthly basis, and then manage the business based on the plans that we put in place on a monthly basis, rather than saying this is what we're going to do, rather than starting in June and saying we're going to work out a budget for the whole of next year. What we would do is have a rolling budget. Oh no, we don't call it a budget, but a rolling financial forecasting, and that works a lot better from the point of view of managing and improving the operation. And it also gets away from this sort of silliness of, did you make budget this month and can you explain it? We want people working on things that are going to move the company forward and make things better, rather than just explaining stuff that was defined months ago. So it's not a, it's a, you know, we used to say we don't do budgeting, and in fact I did say that, didn't I? But that doesn't mean that we don't do financial forecasting, but it comes as a result of the planning process, which is a very key element of Lean.
I am Paul Harbath, the 2015 chair of the ASQ Lean Enterprise Division webinar series. I want to thank Brian for his excellent presentation and thank you for listening to Brian Maskell's Making Much More Money with Lean. If you have any questions about the content of this webinar, feel free to contact Brian directly. Next month, our presenter will be Ron Pereira from the Gemba Academy. Creating a culture of Kaizen ultimately comes down to our ability to motivate and positively influence people. Yes, the tools of continuous improvement are important. No one can argue this, but if you miss on people, it really doesn't matter how good you are at drawing value stream maps or practicing 5S. Ron is one of the founding partners of Gemba Academy. Gemba Academy is trusted by companies around the world for their Lean and Six Sigma training needs. Ron is a great presenter, so watch for it on the ASQ Lean Enterprise Division YouTube channel. You don't want to miss this one. The ASQ Lean Enterprise Division webinar series is the place for you to hear the best of the best in the Lean industry and learn more about how to apply Lean in your application. The American Society of Quality Lean Enterprise Division is a global network of professionals helping individuals and organizations apply proven and leading-edge Lean principles and practices to achieve dramatic results for your personal and organizational success. Come Lean with us. So we'll see you next month.